This is a chart comparing the S&P 500, the blue line, with the Commodity Research Bureau or the Commodity Index, corn, copper, gold, silver. And you can see this wide chasm, this wide gap. This goes back all the way 30 years to 1996. So you can see in 2010, around the great financial crisis, these lines started to diverge, S&P going straight up, and commodities, just hovering at unchanged. And therein, I think, lies an enormous opportunity, certainly given the backdrop of what happened this week. So here is, again, a multi-year chart of the S&P versus the commodity index. Picture tells 1,000 words. You kind of got this long-term inverted head and shoulders bottoming, and you are just about to pierce this downtrend line. Now, again, this is a comparison and overlay of the S&P versus commodities. And you can see that the S&P is been going up way, and now I think that relationship is going to turn. And I think, again, on August 19th this week, we got the tripwire, the catalyst for, so sometimes you marry the technicals with the fundamentals and you have a real opportunity. So not to kind of dig in the weeds, but on August 19th, the Treasury announced that it's going to at least double the size of certain Treasury buybacks, increasing the minimum from $2 billion to at least $4 billion per operation. Now, remember, we have $40 trillion worth of debt. So $40 billion is a blip in the ocean. So at the same time, the Treasury is going to continue issuing enormous amounts of debt to refinance debt that's already coming due. So the U.S. has had budget deficits. It spends more than it takes in for 51 of the last 55 years. I think the last time we had a surplus in the United States was 2001. So basically, the U.S. takes in $5 trillion a year, and it spends $7 trillion a year. So we have this $2 billion a year deficit that is added up to a $40 trillion national debt that we just crossed 40 billion this week. So at the same time that we're trying to issue enormous amounts of debt, there's already old debt that's coming due. So just this month, the Treasury offered 125 billion of new securities to finance the 96 billion of maturing debt. So let's look at this little, Ponzi scheme. The debt comes due, new debt is issued, old debt is refinanced, Treasury buys back the existing debt, and the process continues. So this is a dependency-like Ponzi scheme. The system depends on continually rolling and expanding an enormous amount of mountain of obligations. And that's the part the investors need to understand. You can create more dollars, you can issue more Treasury securities, you can finance yesterday's debt with tomorrow's debt, but you cannot manufacture more of the world's finite resources. You can't print another barrel of oil. You can't print another ounce of gold. You can't print copper, farmland, or energy. And that's why this chart matters. After decades in which financial assets have dramatically outperformed commodities, the question isn't whether the dollar collapses tomorrow. The much more interesting question is what happens when the world begins placing a higher value on things that it cannot be created with a keystroke. Because financial claims can multiply, but scarcity cannot. So I think this is an enormous opportunity for hard assets now, gold, silver, copper.